Richard Calhoun, Creekside Realty. We're here to discuss real estate in the Silicon Valley. First two slides really summarize everything, I believe, but we'll go through the whole presentation. Basically, what you're looking at is in 2023, the blue highlight here, the record low number of offers that are being accepted in the past 5 weeks in Silicon Valley, which is Santa Clara County, San Mateo County, and Alameda County. It's 78% essentially of the 10-year record low, and it's 85% of the 25-year record low. We're not only a record low, we're a record low by quite a bit. And going back over 10 and 25 years is a fairly significant record to be shattering in the negative direction. Now, that's the negative news. The positive news is this slide, which is days of unsold inventory, which is the leading indicator, which tells you how quickly the market's moving. So even though there's not very many transactions, there's also not very many listings, and without very many listings, the few number of listings that are available sell relatively quickly. Now, this is a leading indicator that moves fairly quickly. Just go back a couple weeks ago, and it was not nearly this red meaning a hot marketplace. This is now looking at the sort of the time that any particular listing stays on the market, but the listings that we're focusing on are the sellers that take the longer. It's the 75th percentile. So sort of the long but somewhat normal sellers, how long they're on the market in the different micro market areas. And Alameda sneaks in right up here, and Berkeley is right here in the red here, and this blue here represents Oakland. But what you're looking at is a fairly quick marketplace, although there's clearly some slow areas. South County, East San Jose, Saratoga, Los Gatos, the expensive areas in San Mateo County and the San Mateo County coast. But I think if we go back and look at it, what's interesting is if you look at East San Jose and South San Jose, Central San Jose, it's actually moving relatively quickly. When you look at days of unsold inventory, you're looking at 28 days of unsold inventory, but yet the seller that's taking the 75th percentile time to sell is almost at 47 days. So there's quite a bit of difference there. Now we're looking at ask price reductions. This is where sellers reducing their own asking prices the most. And again, red is hot, so red would be the least amount of price reductions. Blue would be a cool marketplace, so those would be the most price reductions. So you're starting to see some similarities between asking price reductions and the 75th percentile on time on the marketplace. Now you're looking at overbidding. This is looking at the overbidding that the buyer does based on the asking price at the time that the offer is accepted. So red is a hot marketplace, and you can basically see there's almost no red. Believe it or not, Oakland, Alameda, and Berkeley are the hottest up here at 104.2%, actually outbeating Saratoga, Los Gatos, which is a little bit unusual at 102. Cupertino, Sunnyvale is usually one of the hotter spots, and it's sitting there at 101%. There is a little bit of overbidding, but nothing like the 118% that we saw just a year ago. This is the frequency of overbidding. How common is overbidding? And you can see there's a faint shade of pink over here in the Cupertino, Sunnyvale area, but most of the areas are white, which basically means no real significant overbidding, somewhere between 33 and 50%. And you go most places in the country and probably even in the world, and you say, a third to half of your sellers are getting overbid, and they go, wow, that's pretty darn good. It's only when you get below a third of the sellers getting more than their asking price do I change the color to blue for a cool marketplace. Now we're looking on the appreciation. This is the appreciation since 2015. It's actually April 1st of 2015 through the end of 2015, and the appreciation all the way to the current time. The red areas are the areas that have had the most appreciation, and the blue areas are the areas that have had the least appreciation. And there is quite a bit of fluctuation, basically from 170%, say in Saratoga, Los Gatos, and Milpitas, Berryessa, as well as the affordable areas of San Jose, to a low of 20% in areas like Oakland and Berkeley, and even Los Altos and Palo Alto. There is quite a bit of fluctuation, and part of it might be the timing of the market. Well, it is the timing of the market of when I took my base, which is one of the reasons I took a whole year. I picked a year where the prices were pretty stable, and the current time. Part of what was happening back then is we were just coming out of the 2008 recession, and so there was the low end was more negatively impacted than the high end in in general terms, but that doesn't explain Los Altos and Palo Alto having some of the least. And I think they're getting impacted because they're the areas that are not doing very well right at the moment. This is the sold price. If you're white in color, you're basically right at the median. As you get shades of pink, you're hotter, you're more expensive, and you get shades of blue, you're less expensive. So you very quickly can see the affordable areas over here in Alameda County in the southeast area of Santa Clara County, as well as the northwest area of San Mateo County. Continuing on with Silicon Valley, and what we're looking at is the components. We're now looking at the inventory, and we're looking at it compared to a cool marketplace, which is the fine blue line up here, a normal marketplace, the thin black line, and a hot marketplace, the red line at the bottom. The purple line is the current data. We can see you're between a hot marketplace and the typical marketplace. We're actually selling properties. We have less properties to sell now than we typically do. Typically, you'd expect to be up here somewhere around, call it 1750 for better numbers, and you're probably down here somewhere around 1400 homes. So you have fewer homes to choose from, which is why we can have record low number of transactions and yet be having a fairly quick turnover of the marketplace. This now is looking at the number of offers, and you can see here's where the record low starts showing up. The purple line is the current data. You're selling less than 100 homes. Normally, you'd be up here north of 2,000 homes being sold. Yeah, north of 2,000 homes, maybe around 2,150 homes. And in a hot marketplace, you're almost at 2,400 homes. And in the cool marketplace, you're down here around 19. We're down here something like 1,475. Again, the big takeaway is we're selling fewer homes now than we typically do, and fewer homes now than we have any time in the past 25 years. This is number of closed transactions, very similar to the previous slide. It's starting to show the lag. This is just turning around where the previous slide turned around several weeks ago and has already come up fairly significantly. So this is offers that were accepted, and this is closing. So you have the lag time for the length of escrows. Here is looking at days unsold inventory, which is typically my big bellwether. So the blue line is pointing to, and if you look very carefully, you can see the thin blue line behind it, which is sort of the coolest marketplace we ever have. So we're below that, which means the market's faster, but we're above the black line, which is typically where we are at this year. So you're fairly close to a typical year. You're sort of a little bit on the slow side, but again, when you combine that with the low level of inventory, you can have record low number of transactions and have a fairly quick pace marketplace. This is simply the median days on the market. I don't think it tells you that much because you can see it jumps from, well, that has to be 7, so 7, 8, 9. So it bounces and it doesn't give you a lot of trend. That's just what the typical midpoint seller is doing. I'm starting to really like this number that I introduced fairly recently, which is what is the 75th percentile doing on the marketplace. And so the seller that's taking sort of the long side of normal is up here just shy of 50 days, call it something like 48 days. The slowest we typically are is something like 44 days. So you're a little bit slower than you typically are, but we're nowhere near where we were in our hottest years down here at 20 days on the marketplace for the 75th percentile seller. Here are the sellers that are the 10% of the sellers that are taking the largest price reductions on their own asking price. And the reason I'm looking at this number is it gives you an idea what the sellers that are trying to sell are doing, and it doesn't require the escrows to close. You get a sense a little bit earlier in the marketplace, and you can see that the trend is up, but normally you're up here. Again, sellers are taking bigger discounts, not dramatically bigger, but bigger discounts than they typically are, but we're following an absolute normal pattern. Basically, we're having a normal year with less inventory and a lot less transactions, but when you going out there, you're feeling the competition, but you're not having to overbid. And if you do overbid, you don't have to overbid very much. Here's the average ask price reductions. So this is the list price to the original list price. So this is the average. So again, you can see that right now, the purple line, we're taking bigger discounts than we typically are. It is interesting that typically you're taking very little discounts, and that's just the way Silicon Valley is. the Silicon Valley median overbid. So this is how much overbidding people are doing on normal, the half above and half below. So right now, half the sellers are getting a little bit less than their asking price. Typically, the coolest GR is the blue line, which is right at 100%. Typical is up here somewhere around 101.5%. And the hottest we were is up here somewhere around 107%. The 118% that we had was basically right here. And when you look at all of Silicon Valley, it looks like it comes in closer to 117%. Here's the average overbidding. The average overbidding is what the typical seller gets. Maybe that's what I was thinking, because that is a little bit over. It's almost 118.5%. Again, we're currently below. We're following the normal trends. We came down at the end of the year holidays. We turned around and we're going back up again. Absolutely normal marketplace. Frequency of overbidding, again, less than you typically would expect. The worst you'd expect is up here around 45, and instead we're down here probably around 39% of the sellers getting more than their asking price. Here's what's happened to price over time. Just for Silicon Valley, that product doesn't exist because you're buying in a micro market, not the combined blended product. But this becomes, in my opinion, a little bit more interesting where you plot it on logarithmic scale. I just eyeballed the straight line through it. When the current data, the purple line is above the blue, you'd expect downward pressure on pricing. When the purple line is below the blue, you'd expect upward pressure, because this is basically your average rate of appreciation, the straight line that I just freehand through there. And that's the rate at which you'd expect homes to go up. And we're now down below that. So there is upward pressure on pricing, even though we have very few transactions. Now we're going to look at something a little bit different. We're going to look at each week, and I have revamped these. I'm leaving all the weeks on here so you can see, but I am going to bold out the current week as we go through it. And we start a year ago. The up red arrow only indicates an improving market. The down blue arrow, which would be normally bolder, is indicating a decreasing marketplace. When they're both there, you have a plateau, and it's on here only to show what I'm talking about. The dotted dashed blue line down here is the worst week we ever had, which was right after World Trade Center, November of 2001. And the best week we ever had is the dashed red line, which was just earlier this year, which was March 29th for 2022. Last year, sorry, we're getting real close to March of this year, so essentially a year ago. And then what we'll do is we'll step through, initially jumping up at a time, then a week at a time when we get to 12 weeks, and then we'll jump to 1 week in the future. So here's 11 months ago, 10 months ago, 9, 8, and you can see it's just dropping, free falling almost. And now it's going to level off, and that's why the red arrow came back. You can see the lines are coming on right on top of one another. Now you're going to see it's going to start going down because you got down to where the purple line is. And now you're going to start improving because you're now below the purple line. And the green line is jumping forward to last night at midnight. And it's actually sort of interesting on how much it's jumped up from the purple, because I use a 5-week moving average. So there's 35 days on both lines, and 32 days on the green line is the same. There's only 3. You dropped off the oldest 3, which would have been back at the end of the year holidays, and you added the newest 3s, and yet you've jumped up quite a bit at the higher end here. So it's going to be interesting to see how much, if that trend continues, because we have 4 more days before we become the purple line next week. Here's a new table that's expanded a little bit. Here are your micro market areas over on the left for Silicon Valley, and then the key indicators that we went over. The days of unsold inventory is sort of the key, and you can see across the board you basically have pink in color, which would be a hot marketplace. And you can just look at these numbers of days and say, 16 days, 21 days, those are all very very aggressive marketplaces. But then you have to look at what's happening. 75 percentile sellers on the market. These are longer because we just came through the holidays. So anybody that's on the market now is either brand new on the marketplace or came through the holidays and has a lot of days on the marketplace. Then you have the list price to the original list price. This is the sellers taking price reductions to try to sell their properties. Red is a hot marketplace, which is what I try to be consistent with. That would be sellers that are raising their asking price. That doesn't happen very often, so it's very hard to go above 100%. But it does happen when a seller takes more than their asking price and the listing agent feels that they need to raise their asking price in order to not cause an appraisal issue. Then you have the sale price to list price ratio. Here you have to wait for escrows to close, and so you got much cooler colors both in the magnitude and the frequency of overbidding. And then here's the appreciation. And this isn't, I guess this is almost a hot, cold marketplace, but it's the hottest would be the most appreciation. You can see we've had almost 70% appreciation in the hottest areas since 2015. And the coolest areas are just down around 125%. I think the lowest is 120% in Oakland. Then you got several coming in around 126 and 128%. There's quite a bit of difference, 40% appreciation difference between your hottest and your coldest area. And then you simply your hottest and coldest prices here. So you can find your price range and then find your conditions, or find the area you want to look at, find out what price range you're going to be in and what the conditions are. Here's days of unsold inventory going back over time. You can see how dramatically this has improved in the last 3 weeks. And even this week over last week, almost across the board, every micro market area is a shade of pink darker, and disappearing blue is a shade of pink darker. So here you stayed the same. Here you improved. Here you look like you stayed the same. But the vast majority of these are an improving marketplace. So the market is accelerating despite having record low volume of sales. Here's the component numbers of the 3 things that make up Silicon Valley: Santa Clara County, San Mateo County, Alameda County, and then the combined all of Silicon Valley. So you can see what's going on. You can see that days of unsold inventory down here dropped across the board, except for in Alameda County where it actually went up, which is almost bizarre. And when you have a change of 5 days in a week, and this is a change of 6, I call that pretty significant. So you almost had 4 and you had 6, so that's pretty significant change. The other thing that I wanted to point out, and I have pointed this out before, is when you come down to appreciation now, and this is only since 2020, I have to update this, but that's still a fairly significant measure. But here are all 3 components now have very similar appreciation since 2020, since just before the pandemic. But each component is significantly lower than the overall combined. If the media is reporting on Silicon Valley, which they don't, they report on the Bay Area. But when you report it on Silicon Valley, you'd report you had a 22% appreciation in the last 2 years. But if you look at each one of the components, you're only down around 6%. And that can happen because there's a shift in the market. You can start seeing it when you come over to the median price, which is on here. For the whole Silicon Valley is only $1,340, $1.3 million. These 2 areas, which are Santa Clara and San Mateo County, their median price is 1.5 and 1.7. Only Alameda County is lower, but if any house, regardless of what county it sells in, sells for above 1.3, it's increasing the appreciation, even though it might be causing depreciation in the respective county. So in other words, in San Mateo County, almost any home selling, because the lowest home is $1 million, is going to be increasing the Silicon Valley marketplace. So if San Mateo County became a more robust volume of area, larger market share compared to Alameda County, you'd have this appreciation difference that clearly doesn't make sense at first glance. This is, again, looking at the volume of sales. The purple or the blue highlight is the lowest. So this is 2023 coming here. This is the future. So we're not there yet. And then I guess I'm actually hiding those and didn't mean to do that. You can see the tail end of last year, and you can see the beginning part of this year. But the big takeaway, in my opinion, is you look at the 10-year history. And the reason I like the 10-year history is, in general, the long-term trend is for volume of transactions to be decreasing in Silicon Valley and in the Bay Area. By looking at the last 10 years, you're sort of comparing your closest to apples, but you're only at 75, 78, 80% of your 10-year normal of the number of transactions. So we're selling 20-25% fewer transactions than we typically, than our previous record low out of the last 10 years. To me, that's significant. I'm hearing a lot of anecdotal stories about how the market's improving. Yes, the market's absolutely improving. It always improves at this time of the year, but we're not going to take off and have our rockets go on fire when we're selling the lowest number of transactions that we've had in the last 10 years. This is not comparing apples and apples, and that's because it's looking at February data, which isn't available until March the 8th. And we're not to March 8th yet, but it gives you some idea of what's going on. You can look at inventory being at a relatively low number, 528. Now, typically, I'd expect inventory to go up between now and the first week in March. If you come down to days on sold inventory, I would expect that to decrease. And if you look at 42, it's one of the largest numbers. So at this time of the year, when you're going through rapid changes, it's really important to compare apples and apples. We're on the steep part of the curve, just like the daylight. The number of minutes of daylight is increasing fairly rapidly. Right around March 22nd is where it increases the quickest. But as you get closer to that, within a month of each side of that, you start adding minutes pretty rapidly. Then if you look at number of sales, now the number of sales is particularly low and 432. And that's because you're going back over the end of the year holidays. In another 3 weeks, you're going to have less of the holiday influence. So that number is going to increase. And the same thing with closings. Closings are what happened, 5 weeks ago, plus you're comparing stuff in the future. So unfortunately, when you're in a steep changing marketplace, looking at future data is not as useful as when you're sort of in a stagnant period. So here's your apples and apples comparison. The reason I don't particularly like this one is you're looking in the rearview mirror. What happened in the month of January? This is where the market was at the beginning of February. We're quite a bit past that. When I say quite a bit past that, we're basically 2 weeks past it, because that's the data that was out on February the 5th. Now we're looking at the components of Silicon Valley, the 3 counties that make it up: Santa Clara County in the blue, San Mateo County in the orange, and Alameda County in the gray. So you can see the relative size of the number of new listings. They're all doing the same thing. You can see there was a huge spike in the number of listings in San Mateo County last week, and it disappeared. Here's the number of offers accepted. You can see all 3 are going up. You have to go back and see that you're going up dramatically at this time of the year each time. What you have to start looking at is the number of offers. The valley here was lower than any previous valley. And if you're able to pick out this date, February 17th, midnight, go back and find it, you'll find that this is also a record low. Here's your days on sold inventory. All 3 are diving, which is an improving marketplace. You can see the blue here, Santa Clara County, the gray Alameda County, and then San Mateo County. So they're all falling real rapidly. But again, you have to come back and see that they all fall very rapidly at this time of the year. Here's the time on the market for the 75th percentile. The same story as DUI, dropping like a lead balloon, always drops at this time of the year. Even when we were in a super hot marketplace, that came dropping down. This is because the sellers there was very few sellers over the holiday, and so as new properties sell, they have very few days on the marketplace, and that's why that pattern increases. This is the median days on the market. This is the list price to original list price. So this is how much of the seller's discount they're taking. You can see you count all the way down here to 96%, but now you're back up here around 98.5%, 98.75%. San Mateo County appears to be doing the least. Alameda County and Santa Clara County are fairly close together. Here's the overbid. This is the average overbid. So this is what the typical seller is getting in the 3 counties. And because this requires the closing, you can see that it's just now turning around because it lags behind 4 or 5 weeks typically. This is the frequency of overbidding. You can see that overbidding is picking up. It's clearly not where we've been the last several years up here, but we're going in the right direction. And the right direction is obviously subjective. I always look at from the seller's point of view, from the owner's point of view, and not to ignore the buyers, but what's good for the buyer is bad for the owners and the sellers. It's just a nomenclature more than anything. Once the buyer owns the property, they don't want to see the appreciation and the rapid sales and those kinds of things. Look how huge the increase in price is in San Mateo County. I commented that Santa Clara County was actually more expensive for 1 or 2 weeks, right about 3 weeks ago. But look at this huge increase. So they're back now sort of in their normal distribution, their normal order. Basically, the takeaway is, with the benefit of hindsight, is San Mateo County took a bigger hit of the properties over the holidays. And you can see that the holidays is when it came close to hitting here and it came close to hitting here. So the fact that it hit and flipped, shouldn't really be a huge shock. It happened at the time of the year you'd expect, but still the amount of increase here is pretty dramatic. You went from basically 1.5 million to 1.7 million, and you did that basically in 2 weeks. So you went up $100,000 in median price each of the last 2 weeks. This is median sale price on regular graph paper. This is it on log paper. The data lines are absolutely the same, but you can see as you go up, the first million is a very big step. The next 500,000 is a smaller proportional, and the next 500,000 is smaller than this 500,000. And that's so that you can draw the straight line through and get the appreciation. Here's the appreciation since 2015. And again, that's April 1st of 2015 through the end of April. You can see that San Mateo County, when it went down, it was doing the worst. Now it's second, and Alameda County is doing the worst. So Santa Clara County is doing the best in that measure. It's very important on where you measure your appreciation, and you can see that the three components mirror each other very similarly over the long term. So I don't think you can time or decide one county is better than another. So with that, what we've been talking about is week number 6. We've been talking about Silicon Valley, which is Santa Clara County, San Mateo County, Alameda County, and that was slides 2 through 63 that we're on now. We're about ready to move into the Greater Bay Area, which adds in San Francisco, Marin, Sonoma, Napa, Solano, Contra, Costa, San Joaquin, Sacramento, Santa Cruz, and Monterey. And we're going to be comparing those 5 regions to each other, and we're going to do that graphically. But before we do that, we'll take pause for anyone to have any questions and for me to go over the URLs. The green URL up here is what I call the root URL. That takes you to the archives of these webinars on YouTube. If you add in 2023 to the root URL Saturday morning at 9 o'clock, you get to the live presentation. If you add in H for handout 2023-02-18, the year, month, date code, you get today's handout. It is up. I got it up about 10 minutes before the hour. And if you want any specific episode, you can go year, month, date code. Not seeing any questions. Let me proceed. The one thing that we didn't talk about was my measure. My measure is a little different than most people. I start on March 1st of every year, and I look back 35 days, and then I add 7 multiples of 7 to that. What that happens when we get around to February 22nd of every year, which we're going to hit next week, I jump 8 days if it's a non-leap year, and I jump 9 days if it's a leap year, because I go from February 22nd to March 1st. And I do that so that you're comparing the same number of days of the week every year, and you can compare dates to dates. You don't have to worry about what date it was March 7th in one year versus another year. I balance that out, and I think that makes the most sense for comparing data. I also have micro market areas in Silicon Valley available offline. So here is the 13 counties. I also have Silicon Valley, the combined. I also have the Bay Area, which is the 9 counties that touch the Bay. You can look at the numbers. You can see that San Mateo County, and this is from memory, but I believe I'm correct, just a couple weeks ago was 1480. It's now at 1705. So that's going up 225,000. That's almost $250,000 in under a month. I think it's probably 4 weeks. So that's a pretty dramatic increase, which is why you're seeing it on the line. You can start over here on the left, the number of active listings in each of the different counties, then DUI, the number of offers, median days on market, 75 percentile on the market. So you can see there's a pretty big jump, and the numbers are in Silicon Valley are very similar. And that's what you like to see when you group areas together. You like to see data that behaves similarly. The average list price to the original list price to, actually this is the reverse. It's supposed to be list price over original list price. I got those inverted. Then sale price to list price. So how much overbidding was there? And you can see that only San Mateo County was under. The other 2 counties were over. Frequency of overbidding very similarly, very close to 40%, with San Mateo County again doing the worst. Then your price, not only the median price that everybody follows, but the 10 percentile and 90 percentile, so you get some idea what's happening. And I'm just noticing that my appreciation numbers did not come across, so I will try to correct that for next week. They're basically all zero except for the Bay Area, and I don't know if the Bay Area is accurate, but it looks reasonable. Here's the number of active listings in the different areas, so you can see that even though we're after the holidays, inventory is not really growing, and that's because buyers tend to come out and purchase properties before the sellers do. So you have an increased number of buyers right now without the corresponding increase in number of sellers, which is why we're having DUI drop at a time when we're having very few sales. Here's the number of offers. So the number of offers is increasing across the board in all 5 counties or 5 regions, 13 counties. Here's the number of closed transactions. You can see it's just starting to turn in these 3, which is interesting. And these 2 look like they're still on the downward slide. They'll probably turn next week or the week after. Here's days on sold inventory. All of them are dropping. You can see we're down here basically somewhere around 40. So most areas are between 40 and 60, with Silicon Valley being below 40. Median days on market. And again, I'm almost going to start weeding out some of the data that I don't think is very useful. And I think this is one of them. I'm hesitant though, because it's a benchmark that people would use. A lot of people use average. Median's better than average. So I'm hesitant to eliminate it. This to me is more meaningful. This is the 75th percentile. So sort of the long side of what a typical seller's taking to sell their property. Here's the sellers that are taking the biggest discount. You can see they're all decreasing. They're all getting closer to 100%. So the amount of discount sellers are taking, potential sellers, because these are sellers that haven't sold their properties yet. These are people that are reducing the properties of asking price. And here you can see I have it correct. It's the current list price over the original list price. Here's the average, very similar to the previous slide. Here's the average magnitude of overbidding. So now this is where the buyers come in and where are they doing? And your 100% line's right here. So you can see 3 regions are below 100%. 2 regions, San Francisco, Marin, and Silicon Valley, are now above 100%. Here's the frequency of overbidding. Same concept. I consider anywhere from being basically 33%, which is right about here, to 50% to be sort of the normal range. You can see that we spend a lot of time in that area. You can see that San Francisco and Marin and Silicon Valley has been doing better than that for a lot of the years, and probably closer to 60% typical. You can see we dipped down, then with the pandemic we shot up, and we dipped down dramatically starting in about April of this year. Here's the total appreciation since 2015. You can see that San Francisco Marin has done the least well. You can see the Central Valley has done the best. I think what you have going on here a little bit is, notice how San Francisco and Marin sort of fell out with the pandemic. I think it became remote working. It wasn't as important. Remote working would improve the Central Valley. The other thing that's going on in the Central Valley is you have areas like Mountain House that are building $1 million homes, and $1 million homes is inexpensive compared to the Bay Area, but is very, very expensive compared to the Central Valley. That was both those things combined to pull up the Central Valley. The other counties are doing very similar to one another. And that's the type of thing that I believe happens most of the time, is it takes something outside of the real estate industry to create a demand for one area to appreciate more than another. Clients that come and say, what area should I buy in for the best appreciation? You need your crystal ball and saying, what is the next perturbation that's not expected, and what impacts that going to have in real estate? Barring that, all the areas are going to appreciate at about the same rate. This is the smallest amount of overbidding, so this is the least amount of overbidding that people would pay, if that makes any sense. Sale price to list price, the smallest 10%. This is the median. So this is what the typical seller gets. And this is what the 90%, this is what the seller that's getting the most overbidding is getting. So that gives you sort of a sandwich. If you're a buyer and you want to try to figure out what range should you buy. Now, that doesn't help you out on any one particular property, but it gives you a range of what other buyers are doing. And with that, I'm finished my Bay Area, because it's very similar to the Silicon Valley. And I'm thinking that maybe I have my wrong number of weeks, because I think I had week 6 and week 7, and I'd have to count my calendar, but this is probably week 7. With that, we've gone over this. Does anyone have any questions before I end the meeting? Not seeing anyone unmuting themselves, I will call it a day. Thanks for joining. Have a nice week. See you next week. Bye.